Let's get right into this explainer on Viking Holdings, ticker symbol VIK. Today, we're zeroing in on their Q1 2026 financial health, looking closely at their forward booking pipeline and getting a pulse on the overall market sentiment surrounding the stock. You know, if you follow the travel and leisure sector, cruise lines have been on an absolute roller coaster lately. But Viking, well, they present a really fascinating case study in operational leverage and sheer brand loyalty. Let's see what's under the hood.
Now, before we get completely lost in the spreadsheets, we've got to look past the raw numbers. We need to start with the massive consumer appeal of their core product. Viking basically dominates across river, ocean, and expedition cruising. They've cultivated this incredibly loyal customer base that heavily prioritizes travel. And honestly, as we dissect the financials today, keep this image in mind. This premium experience, it's exactly what's driving the relentless demand we're about to unpack.
Here is our agenda for today. We're looking at 1. A new era for Viking. 2. Q1 2026 financial health. 3. The advanced booking pipeline. 4. Navigating risks and headwinds. And finally, number 5, Wall Street's verdict. All right, diving right into Section 1, a new era for Viking. So, there's a formalized leadership transition happening this quarter. Torstein Hagen, who is just a massive figure in this industry, has moved to executive chairman while still serving as chairman of the board. Stepping up as CEO is Leah Talaktak. She brings nearly 2 decades of experience with the company, so she really knows the ropes. And rounding out the top tier, Lynn Bond is taking the reins as CFO. Honestly, this isn't some chaotic shakeup. It's a strategic evolution. It shows they've got a deep bench of talent ready to guide Viking through a period of serious capacity expansion.
Moving on to Section 2, Q1 2026 financial health.
We are seeing some seriously strong top-line and operational growth here. Just look at these 2 pillars. Total revenue crossed the $1 billion mark for the first quarter, hitting $1.05 billion. That's a 17.5% jump year over year. But you know what's even more impressive? The operational efficiency trickling down to the bottom line. Adjusted EBITDA surged by nearly 44% to $104.8 million. When your earnings are growing that much faster than your revenue, it tells us their fixed cost structure is really starting to do the heavy lifting as they scale. Okay, let's address the elephant in the room. Viking did report a $54.2 million net loss for the quarter. I know, that sounds a bit alarming at first glance, but context is everything. This actually represents a huge $51 million improvement over the $105.4 million loss they took in Q1 of last year. We've got to remember the inherent seasonality of the cruise industry, right? The first quarter is historically the weakest period for European river cruising. So, shrinking that seasonal loss by nearly half, that is a massive win for the new management team. To really get a grip on Viking's balance sheet, we have to talk about net leverage. Basically, this tells us how safely a company can handle its debt load compared to the cash it has and the income it brings in. Think of it kind of like a household's mortgage balance, minus whatever savings they have in the bank, divided by their yearly income. Obviously, a lower number means you're in a much safer spot to handle that debt. And here is where Viking really shines. Their net leverage improved from 1.1x at the end of 2025 down to a very healthy 1.0x as of March 31, 2026. Plus, they're sitting on over $4 billion in cash and cash equivalents. This signals a highly secure financial position. It gives them a ton of breathing room to manage their debt while still funding all those future ship deliveries. Next up, Section 3, the advanced booking pipeline. Before we dive into the data, let's just clarify why we care so much about this metric. Advanced bookings are literally the lifeblood of the cruise industry. These are the payments and firm reservations customers make way ahead of their actual trip. They act like a highly reliable crystal ball for future cash flows. It's very much like a restaurant's reservation book telling the chef exactly how much food to order weeks in advance. So what does Viking's reservation book actually look like? Well, as of early May, an astounding 92% of Viking's capacity for their entire 2026 core product season is already sold. That is effectively a sold-out year before we're even halfway through it. This generated $6.2 billion in advance bookings, which is 13% higher than where the 2025 season was at this exact same point in time. But let's look ahead to 2027, because this is where the story gets super compelling. Even with capacity increasing by 15% in 2027, they're already 38% booked for that season. That translates to $3.4 billion sitting in the pipeline right now. To put that into perspective, that's a 31% jump over where 2026 was at this exact same point in the cycle.
Customers aren't just booking, they're booking further out, and they're doing it at higher yields.
All right, Section 4, Navigating Risks and Headwinds.
Look, every company faces headwinds, and the source materials highlight three main risks here. First is fuel cost exposure. While their river operations are largely insulated by fixed-price contracts for 2026, their ocean operations are still exposed to the open market. Fuel makes up about 4% of their adjusted gross margin, so it's a real, albeit manageable, variable. Second, management noted a brief dip in river bookings due to macroeconomic shifts, though they did successfully counter it with targeted direct marketing. And finally, execution risk. Viking is expanding their fleet capacity by a massive 15% in 2027. They've got to fill those new ships without hurting their pricing power.
Which brings us to Section 5, Wall Street's verdict.
The institutional sentiment right now is decidedly positive. S&P Global recently upgraded Viking's credit rating to BB+, specifically calling out their improved credit quality and strong cash flow generation. Meanwhile, professional valuation platforms like Ticker, using their mid-case models based on those advanced bookings we just talked about, project a price target of around $128. That suggests some pretty significant potential upside from recent trading levels.
Breaking down the broader Wall Street analyst consensus, the picture remains highly optimistic. Nearly 65% of covering analysts rate the stock a strong buy, with another roughly 18% at a standard buy. Combine those, and you're looking at over 80% bullish sentiment. Across all these analysts, the average consensus price target sits right at about $102.88.
So here's the ultimate question you should take away from this explainer today. As global economic tides shift and consumers weigh their discretionary spending, can Viking maintain this relentless booking momentum to fill a fleet that's expanding by 15%? Well, if their 2027 forward pipeline is any indication, their incredibly loyal customer base isn't slowing down anytime soon. Thanks for joining me to break down these numbers. Definitely keep an eye on those advanced bookings next quarter, because honestly, that is where the true story of this company is being written.